Thank you all for joining. My name is Warren Covert, and today we're going to talk about early retirement strategies for FSOs. Let's get ahead and get started to respect everybody's time. A little bit of background. My name is Warren. I am a fiduciary. I hold a FINRA Series 65 license, and I also hold a BBA from the Haarlem Business School in the Netherlands. That's also where my accent is from. I'm a dual citizen. I'm also an EFM, currently posted in Dhaka. Small disclaimer before we move forward is that everything we're going to talk about today is educational in nature. It's not personalized financial investment, tax, or legal advice. If you do have personal questions or want guidance of a personal nature, just send me a message, respond to an email, or scan the QR code on the last slide. These are tonight's main topics. First, what is FIRE, Financial Independence, Retiring Early? Specifically for FSOs, what makes the difference here? Going to talk about strategies you can deploy and you can leverage to work towards your early retirement goals yourself. And we're going to follow along my demo clients, the Canons, throughout this webinar to see how they navigate the strategies we're going to cover. So financial independence, retire early. Many of you can retire at 50 with 20 years of service, which is traditionally a very early retirement. So when you actually do start to plan for this and realize it starts all with setting a goal. For instance, my financial independence goal could be having $10,000 a month available in retirement without working. Some of these $10,000 come from your TSP, from your pension, other come from Social Security later, as we're going to see. But you're going to have many income sources in retirement. And some clients already passed their financial independence number and they stay on working. Because working becomes something optional, something recreational, and they know what will happen if they would walk away tomorrow. What makes FIRE unique for FSOs is these 4 strong benefits. So you have your pension system, FSPS. So every paycheck you pay into this, you'll see a deduction toward FSPS. And what this is, when you retire, your W-2 salary disappears. Instead, you get this pension, which is basically a taxable salary you're going to receive for the rest of your retirement. And if you retire early, like what we're talking about today, you even get an annuity or a pension supplement, so a bonus. And this lasts until you reach about 62. Health insurance, FEHB, is another really strong benefit that you can keep throughout retirement. This is really going to limit your out-of-pocket costs, specifically when you enroll in Medicare at 65. Next up, our TSP. Really great for building wealth. For distributing wealth, it leaves things to be desired, but while you're working, you can build investment strategies with the 5 funds that they offer. We're going to talk about this later in this presentation as well. And your overseas housing benefit. So this frees up a big portion of your paycheck as soon as you go overseas. And especially if you're trying to retire early, if you have savings goals, what you're going to do with this newly freed up part of your paycheck can move the needle in your favor. Let me introduce you to our demo clients case study, George and Annalise Cannon. Famous diplomats, and this time around they want to retire at 52. They started this FSO adventure when they were 32, so after 20 years they're eligible for a full retirement. They need a 10-year income bridge because at 52 they do get that FSPS and their annuity supplements, but only at 62 one of them will be eligible to withdraw Social Security benefits. And they manage one investment property throughout their careers. They have no intention of becoming multi-property landlords. I'm going to see how they leverage their tax valley years, how they manage their real estate, and how they control their spending and keep their savings rate up throughout their career. And this is where they are today. They just onboarded as clients, and their particular goal for financial independence is having access to $12,500 a month without working. So they just onboarded. They're about 8% of the way there. And we measure this progress based on their tax strategy, savings, investment strategy. Like I said, they own real estate. So they still have a long way to go. A lot of decisions to make, lots of financial decisions to implement, lots of strategies to follow. And they know that the $12,500 is going to come from their pension, their TSP, especially in the earlier years, and later on, the $12,500 is largely going to come from their Social Security checks and their pension, thereby relieving the TSP of some withdrawal pressure. And this year, they can take a couple of actions already to move toward that goal. So they just started, and if you just started in your career, you're allocated in the L fund in your TSP, so the investment decision has been made for you, as well as how much you contribute, typically 5%. So in year one, the canons will optimize their investment strategy. They get out of the L fund and move toward a more growth-oriented strategy, particularly the C, S, and the I funds in their case, also going to increase their contributions to their TSP. So they're going to contribute a mix of traditional and Roth funds, and they're going to control their spending as well. So they're going to measure how much comes in, and with one of them being an EFM, this is variable. Like FSOs manage varying cash flows, so it is not always easy to keep your savings rate up. With a proper cash flow map, they know each year what is going to come in and what they'll spend and how much of that salary they actually save and put toward their financial independence goals. And because they're diligent savers, they've rented out their house, they are going to contribute extra to a Roth IRA. But because Roth IRAs have an income cap, in this case, they're going to max out a backdoor Roth strategy. When I start working with people in their early career, they're typically like 5 to 10% of the way there because their timeline is long, the timeline towards retirement, lots of decisions to make, lots of decisions and also stewardship needed to keep the plan on track. And once clients near those 20 years, near their financial independence date or goals, the strategy will emphasize conservation of fund, like protection of what they built as well, mixed with long-term growth. Because when you retire early, your retirement can still be a pretty long time, especially at 50. Some of you are going to be retired for 50 more years. So this is where the canons are today. And in your career, you're going to see multiple phases of wealth building. So you develop as an officer and your investment strategy in your TSP develops with it. And the TSP has 5 funds. And before we talk strategies, let's quickly cover what these 5 funds actually hold. So if the C fund, it's the S&P 500, 500 largest companies in the US. So I think Microsoft, Nvidia, Apple, names we all know. There's the S fund. So the rest of the US stock market that the C fund does not cover. So these 2 funds, a mix of these 2 funds covers the whole US stock market. And then there's the I fund, international fund, gives you additional diversification options. Particularly, it invests in about 5,000 international companies, excluding the US, China, and Hong Kong. And then there are the 2 conservative funds, the F and the G fund, with the F fund paying a moderate interest rate at moderate risk. So it invests in corporate debt in the US, and the G fund, which has the lowest projected interest rate. The G fund is the only fund where you're actually guaranteed to get your principal and interest back by the Department of the Treasury. But this security comes at the cost of low projected returns. So early in your career, when your investment timeline is the longest, most people have more appetite to take on risk than further down their career, at which point you invest in growth, which is mainly driven by the C, S, and I fund, with the C fund at its core. As retirement approaches and you start building a lot of wealth in your TSP, at some point you're going to think, if the market tanks tomorrow, will I still be on track to reach my retirement goals? Like, what would happen? At this point, you start to transition into a more defensive approach, a defensive strategy, and you do this by adding more of the F and the G funds to your TSP, either with future contributions or investments you already made, and shift the allocation. And that is because when the market tanks, markets do this from time to time, when the market tanks, the F and the G fund won't go down as much. The G fund actually hasn't gone down at all much as the other 3 funds you use for building wealth. So by the time you retire in retirement and you need part of the TSP to cover your short-term expenses, going to strike a nuance between short-term expenses, so what you hold in the F and the G fund, versus long-term growth, what you hold in the C, S, and the I funds. That is because when you retire early, part of your TSP still needs to be invested for long-term growth, because a 30 to 50-year retirement is still a long-term investment horizon in my book. And throughout it all, you can open taxable investment accounts, Roth IRAs at other brokerages of your choice, which give you extra opportunities to save, but also to invest in asset allocations not always available in the TSP. Extra accounts outside of your TSP used for extra savings and extra diversification. When you work toward your early retirement goal as an FSO, you typically have these 5 building blocks. With building block number 1, really leveraging that traditional TSP. A lot of people have heard stories that they put everything in Roth TSP because they expect to make more money in retirement. That may be true, but what's more important in retirement is your taxable income, which we're going to cover later in the tax valley strategy. So every dollar you put towards your traditional TSP will not be taxed today. Once you've mapped out how much you want to save in your traditional TSP every year, because you have this cash flow plan, you know how much your income is, you know how much taxes you're going to pay. The next step is to start saving in your Roth TSP. Funds you save in your Roth TSP will be taxed today, but then in your TSP, they continue to grow on a tax-free basis. And retirement, you can withdraw those funds tax-free as well. So these Roth dollars are going to be the most valuable throughout your retirement, but it's also the most expensive way for you to save up today. You still have funds available or want to save more after maxing out your TSP, then you can open a Roth IRA and contribute to that either directly or through a backdoor Roth like the Cannons, our demo clients. And that is because Roth IRAs have this income cap. So especially if you're a tandem, if you're both working, if one of you has an EFM job, contributing directly to a Roth IRA is not going to be possible every year, at which point you deploy this backdoor strategy. Building block number 4 is what's going to make the difference in your early retirement, contributing to a taxable investment account. Taxable investment accounts are available for you tomorrow, penalty-free. They also come with their own tax advantages, long-term capital gains rate, which is in most cases preferential to their marginal income tax rate. But those taxable investment accounts, you open them up outside of the TSP, and you have access to a range of investments not necessarily available inside the TSP. And the 5th building block, really popular amongst FSOs, is owning and renting out real estate. So buying property before you go out and then having it rented out and have someone else pay the mortgage. And owning real estate can really lower your burn rate in retirement. So it can really mitigate how much you actually need inside your TSP. So imagine if you retire tomorrow and you'd have to pay a rent check of $4,000 a month. This equates to about a TSP value of 1.2 million just to keep covering that rent check throughout your retirement. So owning real estate or starting to pay off real estate while you're working can be part of your investment strategy, of your retirement strategy. And when you leverage these building blocks, what I do for my clients is I measure how much they've built in each particular bucket. So in their tax deferred wealth, their tax free wealth, and also their real estate and their taxable wealth, their taxable savings, so that we can take advantage of tax strategies later on and position them for smooth withdrawals in retirement. Now let's go back to the Cannons for a bit and see how they navigate these 5 building blocks. See here 3 lines. With the red line is their total net worth throughout their retirement. The yellow line, the value of their TSP, their IRAs and taxable investment accounts, so all their savings. And the blue line is the line that shows the value of their real estate. And you see here it dips like right around 52, and that is because they're going to downsize. So they bought a house in the DMV, in this case, before they went out. At retirement, they sell this house and roll the proceeds over into another house where they actually want to retire, somewhere out west in this case. Let's take a look at their savings. They start with about their couple years in their career here, and they have about $200,000 saved up in their TSP, IRAs, and taxable accounts. The value of this account grows throughout their career. That's because we're looking at market averages, so average growth rates. And that growth, it goes exponentially faster the more they contribute toward their TSP. So after about 10 years of both maxing out their TSP, they have almost $500,000 in there just in contributions, at which point market upswings are going to do more for their value than contributions. If you have $500,000 in your TSP, 1% upswing is going to mean your balance will be $5,000 higher that day. The opposite is also true. And then as they approach retirement, that growth starts to slow down. They start to transition toward building their retirement portfolio. They start to protect some of what they built by adding some G and F funds. And those funds just don't grow as much as the other growth funds that they have in their account. When they retire, they start to withdraw, and they start to withdraw a lot in those early years. And that is because in this case, I've modeled in for them that they spend about $100,000 in year 1 of retirement just on relocation costs. Like, of course, their PCS is paid for, but then they want new vehicles, they want to travel. This is a pattern that I see a lot. The decline starts to slow down a little bit throughout their 50s based on their spending, and once they both draw Social Security in their 60s, the value of their TSP actually starts to stabilize a little bit. And that's because most of the $12,500 that they need and want throughout retirement is now coming from their pension, their FSPS, and Social Security. But we also see at retirement, their net worth is the highest it's going to be, their savings level is the highest it's going to be for a long time. And by the end of their retirement, most of their net worth is driven by the value of their home before it catches up again. So this is a major shift in mindset. When you retire, instead of contributing to the TSP, you're now managing a fluctuating portfolio that you're withdrawing from. The income bridge strategy. I've gotten a lot of questions about this during the sign up. I've divided the income bridge strategy up in 3 phases. So George and Annalise, in this case, retire at 52, at which point none of their retirement accounts are available for withdrawals, right? So they retire, they can't access their TSP or their IRAs. They will get that pension. So a small part of that $12,500 will come from the pension plus the supplement. Anything else will come from the taxable brokerage account that they opened throughout their career and contributed to. That's the only account available that they can actually draw money from. Depending on their investment strategy, they either get dividends, they bought dividend-paying stocks, or they liquidate investments and sell them in order to pay their bills from that. Either way, they need these funds on the short term. So I've advised them to build a cash position, a bond position there, so that when the market tanks, they have funds available to fund their early retirement. And when you turn 55, your TSP does become available, at which point you can relieve some pressure from your taxable investment account and start drawing from your TSP as well. This gives you a lot more options, and all other income sources still stay online until they reach about 62. And when you reach 59 and a half, all your investment accounts are fully accessible. So your Roth IRA, traditional IRA, they are all accessible. Just be careful here. If you retire early and you decide you want to roll your TSP into a Roth IRA, now that you've rolled over those funds, they are locked up until 59 and a half. Withdrawing them earlier costs you to pay a 10% early withdrawal penalty. So rolling over some funds to an IRA in retirement can make for more efficient withdrawals. However, rolling everything over from your TSP does postpone the timeline of when you can actually access those funds. So at 62, they stop receiving their annuity supplement, at which point one of the canons will start drawing Social Security. In a couple of slides, we're going to see exactly how much Social Security they get. But drawing Social Security earlier than 67 means you get a discount on the benefit for the rest of your retirement. However, in the canon's case, it makes sense that one of them actually draws Social Security early on, just so that they don't have to withdraw so much from their TSP and they can let the funds in their TSP stay invested for the long term. So what I see here with a lot of FSOs is that once you actually map out your income bridge, actually have a plan for those early years, early retirement becomes a lot more tangible. Also, in early retirement, your tax rate is probably going to drop. This is called the tax valley. Like in your working years, you probably pay about 22% or higher in federal income taxes, mainly because of your high salary, but also allowances. Some allowances also count towards your taxable income, some do not. But in the canon's case, they retire at 52, they stop receiving the W-2 salary, and their taxable income suddenly drops to 10 to 12%. When we talked about those 5 building blocks, I mentioned contributing to your traditional TSP. And so they postponed paying taxes on traditional TSP savings when they were in the 22% federal income tax bracket. Now that they are in their early 50s, they cannot withdraw those funds yet. But what they can do early on is roll them over toward their Roth TSP. So you take your traditional funds, some of them, and you roll them in your Roth TSP. And Roth savings get taxed in the year that they hit the account. But instead of paying 22% federal income taxes on them while they work, right now they only pay 10 to 12% income tax on those funds they put in their Roth account. During the tax valley, they can actually draw income from the TSP under the 10 to 12%. This does, however, take a forward-looking approach, so a good cash flow map, so that you know how much money you actually receive in a given year, how much of that is taxable, and how much room there is left in those tax brackets before you escalate into a higher one again. So this tax valley is a limited window, and it ends at some point either when both spouses draw Social Security, which count towards your taxable income, and it definitely ends when RMD starts in your mid-70s. So if you still have a lot of traditional TSP savings, traditional IRA savings in your mid-70s, the IRS has let you postpone paying taxes on them up until this point, but they have kept track of how much you've saved in there, what that account is worth, and by your mid-70s, they want to collect income tax on those funds, at which point they require you to take withdrawals from that account. Not because they're afraid that you're going to run out of money at that point, they think it's time for you to pay the income tax. So that gives you very little control over how much you actually withdraw, because you already have to withdraw a minimum amount. And at this point, a lot of retirees see their income tax brackets skyrocket as well as their income. So if you sleep on those tax valley years, no one is going to alert you that they've arrived, at least not if you don't work with an advisor or keep a good overview of your cash flow. Right, so your traditional TSP will keep compounding on a tax-deferred basis until you reach your mid-70s, and then you have to withdraw those funds. And on top of paying income tax on those funds, you now also remove them from their tax advantage status. So once those dollars leave the account, they leave their tax advantage status. You can reinvest them in a taxable investment account, keep them in a savings account, but a lot of benefits won't be available anymore once you're required to withdraw them. So why delay Social Security? In the case of the Cannons, one of them withdraws at 62, and you see that the benefit is $1,800 in this case. However, Social Security is a benefit that comes from your full retirement age from 67. So every year you withdraw before 67 up until 62, you get an 8% discount on that benefit for the rest of your retirement. However, every year you postpone withdrawing that benefit, you get an 8% increase. So you get retirement credits up until age 70, at which point their benefit becomes about $3,200 a month. Especially for married couples, some would choose to withdraw early on and the other choose to postpone as long as possible to at least maximize one benefit. And this is not only a math question. Don't just base when you're going to withdraw on your break-even point or how long you think your retirement will last, because it also means the later you withdraw, the later you have funds available in retirement. And perhaps in the case of the Cannons, they won't enjoy that higher Social Security benefit as much in their 70s as they would have enjoyed that lower benefit when they were in their 60s, because at that point you may still have more appetite to travel, you may want to take out your grandkids. That $1,800 early on can be worth more for people than $3,200 later in retirement. So this is not only a math question. It's really have a plan and think of the why when talking about Social Security or when thinking about it. But the Cannons also bought real estate. They bought one property before they went out, and early on in their career, they paid the mortgage. They had renters, but the rent did not fully pay the mortgage early on. It took a couple of years for them to break even. This happens a lot, but at some point, rents are projected to, in many cases, to at least break even with the mortgage. Rents tend to rise with inflation. Your mortgage rate tends to be fixed. However, your taxes and your insurance rate will increase year to year on your mortgage. Owning real estate in retirement is definitely going to lower your monthly burn rate. If you don't have to cover a rent check, keeping your fixed expenses low, that rent check, like we said, is $4,000 a month. Equates to about $1.2 million in TSP savings. Owning a home can be expensive. You're going to deal with vacancies, stuff breaks, renter's insurance. The math does start to work out in many cases at some point, but in many cases not from day one, when it actually feels like it matters the most. It also hedges against market volatility. So if you pay for all your retirement expenses from your TSP and all your wealth is invested in the stock market and the stock market goes down, the value of all your retirement savings goes down. If you do own a home next to that and the stock market goes down, your home is likely either to keep its value, perhaps it drops a little bit. And the third and important point is that you can actually realize rental income when you rent out your house. So the TSP, Roth IRA, they all have maximum contributions. There's a maximum what you can save in these plans that works for your retirement. And you start seeing owning a property and renting it out as part of your retirement savings, part of your long-term plan. Now suddenly you're saving a lot more for retirement than just the TSP and your Roth IRA funds. So owning real estate can be stressful, can be a lot of work. but the rent, the income that it can provide, the upsides that it provides, the opportunities can definitely make the math work out in your favor. There's some common failure patterns I see. We've talked about what works, but what doesn't work. Number one, no clear income bridge. People retire and assume they're going to live off their retirement accounts, and not necessarily, because not all accounts become available at the same time. Also, no tax strategy. And I don't mean just not taking advantage of your tax valley years. Your tax return in retirement is going to be much more complicated than it was during your working years. In your working years, most of your income comes from your W-2. But once you retire, get Social Security gets taxed one way, traditional TSP withdrawals get taxed another way, long-term capital gains, a lot more different taxes that you are encountering more frequently. And no one is going to withhold most of those taxes for you. So if you don't hold those taxes apart, then on April 15, you will get a letter with a bill. Also, over-optimistic spending assumptions. A big thing that I do for my clients is project their cash flow, see what comes in, what goes out every year. We project it over the life of their plan. We're going to contrast this with their expenses today to see whether their assumptions, whether their goals are in line with reality today. Same with margin for error testing. So what would happen if the market tanks tomorrow? Will you still be on track for retirement? And what I see that in a lot of cases, if the market goes down on day one of retirement, a lot of financial plans run into trouble. If the market tanks in year 10 of retirement, does it affect people as much as it would have on day one? But what can be even more devastating to a financial plan is not the market behavior, but high inflation. What happens if prices are even 1% higher than we expect them to be? Especially high inflationary environments paired with low growth is where a lot of plans come into trouble. And it's important to stress test your plans throughout your career just to make sure that you're prepared for whatever environment you encounter in your retirement. And the last bullet here, too conservative in investment strategies. So either early on when you have a lot of time to grow that TSP, but some people choose to add more or too much defensive funds to their TSP. This takes away from future growth. And the same is in retirement. When you retire and you put too many funds into the G or the F fund, thereby taking away from future growth in your retirement. It's going to work out well for a couple of years, but your long-term potential really goes down by investing too conservative early on in retirement. In the case of the Cannons, their plan does work out, mainly because they keep their costs low, either throughout their careers and in retirement. So throughout their careers, they map their cash flow, which is really important to be aware of how much you make, how much you spend, and your savings rate, just to keep that savings rate on track for your long-term financial independence goals. They also started saving early, so they prioritized maxing out the TSP early on in their careers, even though they were not in their highest earning years yet, and all those savings felt like an outsized portion of their paycheck. It did work out for them in the end. They also bought real estate early on, and by deploying tax advantage strategies early in retirement, they actually used the equity they've built throughout their career to purchase that retirement home they dreamed of. And they were properly tax diversified. So they didn't put everything in their Roth TSP. They made use of their traditional TSP as well as their taxable accounts to be fully tax diversified and take advantage of low income tax years. But to bring it all together, when you work towards your early retirement financial independence, build on your pension and your TSP, but don't discount opportunities that are available to you outside of your employment benefits, like the taxable investment account and the Roth IRAs. So when you retire early, you're going to have to build an income bridge or have a plan about how you're going to pay for expenses before your eligible Social Security age. Use the tax valley to really realize savings early in your career and set yourself up for future tax advantage growth. So adding real estate to your retirement portfolio can really pay off for you in the end and reduces how much money you'll need in retirement and how much you actually have to withdraw from your TSP. And the last one, the earlier you start, the longer you have to actually work towards your goals. Decisions you take today really shape tomorrow's optionality. Thank you all very much for joining tonight.